With mortgage rates hitting the highest level in more than 20 years, buyers, sellers, and investors are left wondering if the worst is behind us or if there's more pain ahead. In today's video, we're going to assess the current mortgage rate trend and assess the indicators that could give us a sense of where mortgage rates are headed over the next 6 to 12 months. My name is Eric and I am a professional economist in addition to being a licensed real estate agent in the state of California, so I bring a unique perspective to the housing market that you'll be hard pressed to find on other YouTube channels. Let's get into it. According to Freddie Mac, the average 30-year fixed-rate mortgage reached 7.49% as of October 5th, the highest level in decades. In my last video on mortgage rates, I projected they would reach an average of 7.4%, so I was pretty close on the level of the rate, but I was a bit off on the timing. I thought rates would reach that level back in May of this year, but it took an extra 4 months to get there. The reason why? The bond market. You see, interest rates have been going up as the Federal Reserve has been tightening monetary policy to fight the biggest inflation in 40 years, but the Fed funds rate doesn't directly impact mortgage rates. Mortgage rates are more influenced by what happens in the bond market, mostly by the 10-year Treasury bond. Back in the first half of this year, when I made my projection, I was looking at what the Fed was doing and where the economy and the housing market were headed, and it was plain as day to me that we would get to around 7.4%. The reason it didn't get there sooner is because bond investors were anticipating a recession and Fed pivot in 2023, which would likely lead to lower interest rates. As a result of this, the 10-year Treasury was heading lower even as the Federal Reserve was raising rates. Let's look at this chart again with a 30-year fixed-rate mortgage added in. You can see here that the average 30-year fixed-rate mortgage rate is much more correlated with the 10-year Treasury yield than the Fed funds rate over time. That dip we saw in mortgage rates in the first half of this year was due to a dip in the 10-year Treasury yield, which was due to the bond market's expectations that didn't play out. So far, a Fed pivot due to a recession is nowhere to be seen in 2023, and the bond market has finally woken up to that, which is why we're seeing the 10-year Treasury yield rising to new highs and taking the 30-year fixed-rate mortgage along with it. So that's how we got to where we are today. The next question is, where do we go from here? Market expectations are key to determining this, so we're going to look at two indicators: the Federal Reserve dot plot and the yield curve inversion we're seeing in the market for U.S. Treasuries. First, let's look at the Federal Reserve dot plot they released after their last meeting in September. What this represents is the projections of the Federal Open Market Committee members for where the Fed funds rate is going to end up at the end of the year. We can see here that most members think it will end up higher than 5.5% for 2023, with the median estimate being 5.6%. That is up from the current 5.3% effective Fed funds rate as of the end of September. What this tells us is that most committee members see at least one more rate hike this year. Combine that with Fed Chairman Jerome Powell's message to markets that rates are going to stay higher for longer, and the bond market has finally woke up to that reality. But look where they are projecting the Fed funds rate in 2024. Most committee members project the Fed funds to be lower, with the median estimate being 5.1%. What this tells us is that the Fed is anticipating a pivot in 2024 and starting to loosen up their monetary policy as the economy slows from the higher interest rates that we're seeing now. That's what we're seeing in the Fed dot plot, which does feed into expectations by bond market investors. Now, let's take a look at where the inversion in the yield curve is in order to get a better sense of when bond investors think a pivot is going to happen. Here is the Treasury yield curve as of the time I'm recording this video in the beginning of October. What we're looking for here is when the yield curve stops rising and starts to head lower. This happens between the 6-month Treasury bill and the 1-year Treasury note. This is called an inversion of the yield curve because the short-term yield is higher than the long-term yield. In a normal market, you would expect to get higher yields for longer dated bonds. But when investors expect something like a recession in the works, the longer term bonds have a lower yield because they expect the Fed to lower rates in the future in response to a recession. The fact that the yield curve is inverted between the 6 and 12-month Treasury tells us that the bond market is anticipating a recession and Fed pivot sometime in the next 6 to 12 months. So when we look at these two indicators, the Fed dot plot and the inversion in the yield curve for U.S. Treasuries, their expectations are lining up pretty close that there will be a recession or notably weaker economy in 2024, and that is when the Fed will pivot and begin to lower interest rates. This lines up closely with my own assessment of when a recession could happen. In a recent video on my other channel, PapayaCast, I made the case for why we won't see a recession called before the middle of 2024. I'll leave a link to that video in the description down below if you want to check it out. And here's what that all means for mortgage rates. If you were hoping to see mortgage rates start to come down significantly in 2023, don't hold your breath. The Fed doesn't anticipate lower rates until 2024, and the bond market is now pricing this into treasuries. If anything, I think mortgage rates will inch up a bit more as the Fed could raise the Fed funds rate one more time this year, and the bond market is taking account of this, which is why we're seeing the 10-year Treasury continuing to rise to the highest level in years. We could well see the 30-year mortgage rate head even higher before the end of the year, but likely won't go above 8%. Overall economic activity is going to be the thing to watch in the months to come, as that will determine how the Fed acts and how the bond market changes their expectation, which then influences mortgage rates. If you want to stay up to date on those developments in the months to come, make sure you're subscribed to this channel or my other channel, PapayaCast, and hit the notification bell down below so you know right away when my next video comes out. And if you found this video helpful or at least mildly entertaining, don't forget to hit that like button to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.